value investing stands as one of the most enduring and time-tested investment philosophies, championed by legendary investors such as Benjamin Graham and Warren Buffett. Rooted in the principles of buying undervalued assets and focusing on long-term fundamentals, value investing offers a disciplined approach to navigating the financial markets. In this comprehensive guide, we'll delve into the core principles of value investing, exploring its philosophy, strategies, and application in the pursuit of long-term wealth creation. 1. Fundamental analysis. At the heart of value investing lies fundamental analysis, the process of evaluating a company's intrinsic value based on its financial statements, business prospects, and industry dynamics. Value investors scrutinize key metrics such as earnings, cash flow, book value, and dividend yield to assess whether a stock is trading below its intrinsic value. By focusing on the underlying fundamentals of a company, value investors seek to identify opportunities where the market has mispriced assets, providing a margin of safety for their investments. 2. Margin of safety. One of the central tenets of value investing is the concept of a margin of safety, which provides a cushion against investment risk. A margin of safety is achieved by purchasing assets at a significant discount to their intrinsic value, thereby minimizing the downside risk in case of adverse market conditions or business setbacks. Value investors aim to buy stocks when they are trading below their estimated intrinsic value, allowing for potential capital appreciation while preserving capital in the event of market downturns. 3. Long-term perspective. Value investing is inherently a long-term endeavor, emphasizing patience, discipline, and a focus on the future prospects of a company. Unlike short-term traders who may seek quick profits from market fluctuations, value investors take a buy-and-hold approach, holding onto their investments for years or even decades. By taking a long-term perspective, value investors can ride out short-term market volatility and capitalize on the compounding effect of earnings growth and dividend reinvestment over time. 4. Contrarian investing. Value investors often embrace contrarian investing, which involves going against the herd and buying when others are selling, and selling when others are buying. Contrarian investors believe that market sentiment can sometimes be irrational, leading to mispricings of assets. By having the courage to swim against the tide and buy undervalued stocks in out-of-favor industries or sectors, value investors can uncover hidden gems that have the potential for significant upside when market sentiment eventually turns. 5. Focus on quality. While value investors are always on the lookout for bargains, they also emphasize the importance of investing in high-quality companies with strong fundamentals and competitive advantages. Quality companies typically have durable business models, consistent earnings growth, and robust balance sheets, which provide a level of resilience during economic downturns. By focusing on quality, value investors seek to build a portfolio of companies that can withstand market volatility and deliver sustainable long-term returns. Conclusion. Value investing offers a timeless and disciplined approach to navigating the financial markets, rooted in the principles of fundamental analysis, margin of safety, long-term perspective, contrarian investing, and a focus on quality. By adhering to these principles, value investors can identify undervalued opportunities, build resilient portfolios, and achieve long-term wealth creation. While value investing requires patience, discipline, and a contrarian mindset, it has stood the test of time as a proven strategy for investors seeking to outperform the market over the long haul. As Warren Buffett famously said, "Price is what you pay, value is what you get." Thank you so much for watching, and we'll catch you in the next video. Don't forget to like, comment, and subscribe.